I'm Don Boyd with Rockefeller College, University of Albany. I'm here with my colleague Iman Yin from Rockefeller Institute. We're going to talk about, well, first of all, thank you for the invitation. We're going to talk about analyzing the interplay between public pension finances and governmental finances. This is really largely based on some extensive work that Iman has done. So we and other researchers have examined the investment-related risks to public pension funds, and they're sponsoring governments using stochastic simulation models. We have scenarios of investment returns that vary stochastically. They generally use simple investment return assumptions. Returns follow the normal distribution. Asset returns and government tax revenue are assumed to be uncorrelated. And you see the little diagram to the right that shows you that, and we've modeled them exactly like this. The asset returns derive a pension finance model, and kind of externally, there's an assumption about what happens to government finances, and we often look, at least in our models, at required contributions relative to government tax revenue as one kind of indicator or measure of fiscal pressure. Did I do this right? Yeah. So the research suggests that the real world differs from these simple assumptions. Investment returns and tax revenue may be correlated through the business cycle. There may be non-normality in asset returns. A poor economy may cause investment returns to fall short of expectations. It may also cause tax revenue to fall short. So it could be that the increase in required contributions may cause additional fiscal pressure, certainly as measured relative to tax revenue. So, and the model kind of on the right depicts that, where business cycles and asset returns are correlated and business cycles have an impact on governmental finance. What we have done, really, this is largely Iman's work, is we've developed and linked a small macroeconomic and investment returns model to both a pension fund simulation model and models of governmental tax revenue to try to get at this question of how this correlation could affect fiscal pressure. And we've got kind of 5 boxes, and Iman's going to talk about each of the boxes. I'll quickly give the overview. We have off on the left, it starts with an economic scenario generator that generates scenarios of real GDP growth and also asset returns. And on the top, the GDP growth, and in our case, stock returns, affect the tax revenue of governments, and asset returns affect the pension simulation model. We then have stylized governments that, depending on the structure of their taxes, affects how their tax revenue, and then we put that cyclical tax revenue together with the required contributions out of the pension simulation model to get at fiscal pressure. With that, I'm going to step down and let Iman talk about the rest of this.
Okay. Thank you very much, Don, for the introduction and the overview of the model. And so next, let's look at these major model components in greater detail. So first, let's look at the economic scenario generator. So we have built a small-scale macroeconomic model that can generate internally consistent stochastic scenarios of real GDP growth and asset returns. So for the GDP growth model, we want to capture the general historical pattern of business cycle, especially the length and frequency of recession periods in history. So we model the GDP growth using a two-regime Markov switching process that consists of an economic expansion regime and a recession regime. And we allow for the economy switch between these two regimes based on the estimated transition probability. And for the stock return model, we want to incorporate the observation that severe economic downturns usually come with severe market downturns. So we've also modeled stock returns using a two-regime process. So it has a high return, low volatility regime, which is aligned with the economic expansion regime for the GDP growth. And there is a low return, high volatility regime, which is aligned with the recession periods for the GDP growth. And this two-regime model structure also allows us to generate stock returns that has a fat tail characteristics that cannot be captured by the simple normal distribution. And for the bond return, in the current version of the model, we do not model them econometrically because they're the weak historical relationship to business cycle. Instead, in the simulation, when producing the simulated variables, we construct stochastic bond returns that have correlations to stock returns that are consistent with their historical correlations. So we do 2,000 simulations for each of these variables, and the simulation horizon is 30 years into the future. And then the simulated variables are fed into a model for tax revenue for of major individual tax categories. So in our model, we examine 4 major categories of taxes: the personal income tax, the general sales tax, the selective sales tax, and other taxes as a group. And the table on the right shows the tax structure for state and local governments. And in our paper, we just focus on the state government. And when doing the simulation, we decomposed the tax revenue growth into a long-term trend component and a cyclical component. So individual taxes can have different long-run behavior relative to the economy. For example, the progressive income taxes will generally grow more quickly than the economy, and have seen that the sales tax bases have been declining relative to the economy over time. But actually, the long-term trend can be heavily affected by the changes in the tax rules, which cannot be effectively projected into the future. So in our model, we just make a simple assumption that the politicians will adjust tax bases and rates to maintain their shares of the economy stable over the long run. But we allow for cycles around this long-term trend. And this figure shows the cyclical components of the major tax revenue sources and compare them against the cyclical component of real GDP growth. So we can see that both sales tax and both income tax and general sales tax have very prominent cyclical behavior, and the cyclical behavior in income tax is even more strong than the general sales tax. So some recent research suggests that important reason why income tax have stronger cyclical behavior is that it is not only affected by the economic conditions, it's also affected by how the business cycle affects the reinvestment returns, and in turn, the capital gains from the asset value. So in the model for income tax revenue, we also incorporate the asset returns as the independent variable. So the total tax growth for each of the individual tax category are the sum of the cyclical growth rate and the trend growth rate. And we assume that the trend growth rate is 1.9% in real term, which is based on the CBO projection for the long-term GDP growth. And the cyclical growth rate is based on our estimated elasticity of the tax revenue with respect to GDP growth. And in the case of income tax revenue, also the elasticity with respect to stock returns. Okay. And then we combine the individual taxes to construct the total tax revenue of 2 stylized governments. The first one is the personal tax dominant state government, and the second one is the sales tax dominant state government. So here we plot the share of the individual income tax in the total tax revenue against the share of the general sales tax. So our sales tax dominant states represent states like Texas and Florida, where there's no personal income tax. And our personal income tax states represent states like California, New York, where income tax accounts for more than half of their total tax revenue. So here we have the tax structure we use in the simulation model. Okay, so by this point we have the simulated total tax revenue for the stateless government, and then we calculate the required pension contribution for this from this government using a pension simulation model. So this model takes the investment returns generated by the economic scenario generator, and then calculate the funding status and required government contribution to the pension fund for the 2000 stochastic simulation into the next 30 years. So by this point, we have the finances of the government and the finances of the pension fund all generated within the coherent simulation framework. And then we can combine that to examine the compounding of risks from the correlated investment risk and the government finance. So we compare the stateless governments with the baseline model with no linkage between model components, and alternative model structures where we have only a partial linkage. And we will see how pension-related risks can be understated if the linkage is ignored. And we also see when the linkage is taken into account, how the increase in the risk can be decomposed into different factors. And we look at two types of risks. The first one is very high government contribution relative to tax revenue, and the second one is the sharp increase in employer contributions. And this table shows the risk measure for very high employer contributions, which is measured by the probability of employer contribution as a percentage of total tax revenue being more than 5 percentage points above the year 1 level in the simulation at any time during the next 30 years. So we have also simulated 3 different funding policies for the pension fund. And the first column is the benchmark, the baseline model where there's no linkage between model components. Not surprisingly, you can see that the risk measure is the lowest among all model structures. And in the second column, we add the linkage between GDP growth and asset returns. And the third column, we add the linkage between GDP growth and government finance. So both of these two model structures have partial linkage. We can see that the partial linkages will only lead to moderate increase in the risk of pension-related risks. But when we allow for the full model where we have a linkage between GDP growth, government finance, and asset return, we can see a sharp jump in the measure of risks. And we have the last 2 columns show the risk measure for the 2 stateless governments. You can see that the risk measure for the income tax dominant state is the highest among all columns because it allows for the correlation between government finance and the volatility in the capital market. So the conclusion is that it's very important to incorporate the correlation between government finance and pension finance when evaluating the pension-related risks. And when that is taken into account, the risks can be even larger than commonly understood under simpler assumptions. So the results suggest that more stress testing and reporting are needed to better understand and communicate risks, and we hope that is the wave of the future. Okay, thank you.
Hi, everyone. My name is Laura Quinby from the Center for Retirement Research, where I'm an economist, and now I get the joy of a PC and slides. Is anyone here good with that? Like any good academic, I have slides. Like any good academic, I can only use them on my own computer. Great, thank you. All right, thank you. So I am delighted to be discussing this paper by Iman and Don. I really want to congratulate them on a phenomenal amount of work. I can say from highly unpleasant experience that this type of model really involves a lot of coding and a lot of angst, and they've managed to pull it off. So the main takeaway that I brought from this paper is that government pension contributions are countercyclical, and that they're likely to grow at a time when governments can least afford them. And the authors present what I think is a really novel finding in the literature, that the stress is worse for states that have more pro-cyclical revenue streams, such as an income tax rather than a sales tax. And they also point out, I think, a more commonly accepted view that funding policies that amortize unfunded liabilities over a really long horizon push risks from current generations onto future generations. And the underlying sort of fact of this model is that assets in public pension funds have not only grown quite a lot in the last 20 years, but they've also become increasingly pro-cyclical. So what I've plotted here is just the market level of assets, the total market level of assets in the state and local pension funds over time. And you can see this dramatic run up from 1993 to 2015, which was the latest year of data that I had. And also the increasing volatility of assets growing in expansions and declining in recessions. And both the growth and the volatility stem from portfolios that are very, very heavily invested in risky assets. So public pension funds currently have about 50% of their portfolios in equities, down from about 54% in 2001. Increasingly, they're turning to alternatives, having sort of been burned by the 2008 downturn. Alternatives are up from 15% to about 26% in 2015. And I noticed that Iman and Don weren't able to put alternatives into this iteration of the model, but I do think they're going to become more important in the future, and I do hope that they're able to model some different asset classes. So as a result, pension assets are now following more or less the same path as government revenue, which is what I put up here. This is just the one-year growth in market assets in the large pension funds relative to the one-year growth in own source revenue for those same government entities. And you can really see an emerging strong correlation between the two. But the interesting thing is that although the assets are pretty volatile and are tracking with revenues, pension funded ratios in the aggregate are not improving dramatically even when the economy has been performing well. So we can see that in 1990, the aggregate funded ratio was about 80%. And of course, this is according to GASB standards. I'm not going to argue the discount rate here. It rose to over 100% funded in the late 1990s and early 2000s, leading a lot of analysts at the time to say that everything was all right. And then since then, they've fallen. And yes, there has been some recovery during expansions, but really, if you look at this figure, what you mostly notice is just a steady downward trend. And today, they're about 70% funded according to GASB standards. And I would like to actually bring in here, so as I was listening to the conversation, we at the center really think of the plans as very heterogeneous. I've shown the aggregate funded ratio here, but about a third of them are doing very well, are well funded. About a third are acceptably funded. They should probably make changes to their funding regimes, but it's manageable. About a third are deeply stressed, and these are the ones I think we've been bringing up over and over. Illinois, and even in Illinois, we need to distinguish between Chicago and the IMRF, but also Kentucky, some plans in Massachusetts. So one reason for the secular decline in funded ratios is just that the sponsors have not paid their full arc since the late 1990s. And you do see some cyclicality here. Sponsors are more likely to make their full contributions when times are good than when times are bad, as one might expect. But what's remarkable is that even in the last few years when the stock market has been performing well, sponsors have not been making their full contributions. Sponsors also viewed low costs in the late 1990s as a chance to enhance benefits. So these were retroactive enhancements for both current employees and new hires, and they were unfunded in the sense that even though the plans were fully funded by GASB standards in 2000, since they were so heavily invested in equities, what goes up is likely to come down, and that was not taken into account at the time, at least by a number of sponsors, the bad apples that we're all thinking about. And you can see that these enhancements increase total liabilities per member immediately and permanently. So there's a clear break in the trend right around the time that all the enhancements were made. That break has not come down, although it's started to slow in recent years. It's slowing because sponsors have been making cuts in response to funding pressures after the Great Recession. But because of many state statutes protecting the benefits of current members, these cuts are most often only for new hires. So as has been mentioned, it's going to take many years for the effects of these cuts to actually be fully represented in the liability. So as a result, required contributions are now at their highest levels since the early 1990s. And I'm going to wrap up here. I think that this is very interesting. We do see contributions under what the plan should be paying. So the black line is their required contribution. The red line is what they're actually paying relative to own source revenue. But we're not seeing a sort of cyclical pattern in the contributions right now. We're just seeing a steady increase for all of these political economy factors that I mentioned. So to conclude, I think this paper makes a really great point that heavy investment in risky assets in the pension fund is leading to countercyclical funding requirements. And there's an interesting finding in this paper that the problem is more acute in states that rely on an income tax rather than a sales tax for their revenue. In future work, I would encourage the authors to start including different asset classes in their modeling. But more importantly, I would encourage all of us to start trying to incorporate some political economy into our pension forecasting. I know it's really difficult, but I have a hard time thinking about how to forecast pension stress over a 15-year period when the legislature is determining a lot of really important variables that we're taking for granted. So in particular, I'd like to relax the assumption of paying the full arc, and I'd like to allow liabilities to start to vary along with the economy. Thank you.
I think because we left so many people stranded on the last two, we're going to start with questions. So this gentleman here. We have a microphone.
Screw the microphone. Josh Godbound, Brookings. Laura, you're one-third dichotomy. My question is this one-third measured by number of plans or measured by liabilities? And the reason for asking the question is that the set of issues that Jim Spiata raised, depending on whether or not the distress is a third of the plans or a third of the dollars, affects whether we spend time on that issue.
Yeah, so I wish I'd put this slide in now in retrospect. So it's both number of plans and assets. It's about a third under both measures, which is sort of interesting in and of itself.
I noticed that your growth rate for sales tax was 1.9%. So have you thought about what it would be with the ability of state and local governments to tax internet sales?
This doesn't, no, in no way does this take internet sales into account. That's a real trend growth rate is what that is. That is inflation adjusted. Yeah. So, go ahead, yeah, it keeps up with the economy.
There we go. Okay. So as Don said, this is the 1.9% is the trend growth, and we also allow for the cyclical change in the sales tax growth. And the 1.9% growth is the reason we use that is to make sure that the share of the sales tax revenue in the total tax revenue is stable over the long run. So because we cannot just project very accurately what will happen in the future due to the changes in the tax rules.
So any number of policy choices could get you there. For example, you could have a continuation of the declining base and then bumping it up for internet sales. But in essence, that decline in the base is stopped in the simulations.
Okay. I think there's someone all the way in the back, and then we'll get Natalie.
Thanks. My question is a follow-up for Laura. Oh, sorry. Joe Fleming with the Pew Charitable Trust. I have a follow-up question for Laura based upon the funding. So for the third that are well-funded, third that are sustainable, and third that are deeply stressed, are the groups based upon their relative funding to, or the pension plans' relative funding to one another, or an objective funding level that you determined where states are or should be?
Yeah, so obviously, and this has come up earlier, there is really no well-accepted objective level of what constitutes stress in this arena. How we just did it was we considered any plan that was below 50% funded to be troubled. And how they, and some, I think the plans that are falling into that category would be plans like Chicago that are about 30% funded and where multiple sources are concerned about trust fund exhaustion given their current contribution rates, which are statutorily set, not actuarially set. It's plans like that. Obviously, you could change the definitions however you like, and you would get different proportions. But I think the point I was trying to make here is that we really can't talk about all of the plans as a group facing the same types of pressures or problems. It really is. There are some that are much less financially sound than others.
So I would like to second the desire to have more done on alternative investments. They run the gamut, and so people kind of put this blanket, oh, they're alternative investments, and many people say, oh, bad. You know, not necessarily. I haven't looked in a while, but I know Missouri PERS is very heavily into a range of alternatives and seems to be managing okay. And then others know of the situation in Dallas where we had a lot of real estate investment that was way overvalued and caused tremendous heartache for the city. So I would say that, and also the valuation of the assets and how that's done and sort of what the governing principles are for the valuations, I think are really important areas of future study.
We, Iman and I, will make a trip to Boston soon. We hope to speak with Laura and her colleagues and talk about especially the alternatives and other asset classes.
Hi, this is all really interesting. I'm wondering how, hi, I'm Kim Rubin from the Urban Institute, sorry. How did demographics, right, this came up in the last session, but in your models, you know, beyond the tax information, the demographics of the state or locality especially is also going to affect how this is going to play out in the future, right? And it also is going to affect how much they can put in or not. Is that in your model somehow? And is there a way of playing with how population changes will fit into, like, whether people are worse off or not? I just keep worrying that if you try and increase the amount you're putting in this or anything else where you're trying to sort of build up solvency, you can actually make it worse through sending people going away from the place.
So two things. So in our assumption for economic growth, the 1.9% long-term trend GDP growth is based on the CBO projection that has incorporated the long-term projection for demographic change. And in our pension simulation model, we assume that the workforce will also grow at the same rate as the population. This also, so I think that's around 0.5% annually. But we can also change the assumption for demographic growth, population growth, or the workforce growth to see what will happen under different assumptions of the demographic changes.
And so we have a plain vanilla economy like the national average, okay? Could we look at alternatives? It would probably require some real thought about what that alternative would look like, you know?
Right, it just feels like if you're looking at differences in tax dependency, this would also be something really important.
Right. Yeah.
Sure, yeah.
I think the point you're making is that maybe the correlation between asset return and economic decline are higher when you take into account individual mobility from state to state, right? Like I can flee a poor performing state when times are bad.
Yes.
Or an aging workforce.
Right.
Well, the aging workforce is built into the 0.5%.
Oh, yeah.
Not all states are aging equally, but there are, yeah, but the aging workforce.
Right. The aging public sector workforce is in the model. You know, if there's some change in the characteristics of the economy itself that somehow mean GDP is not a good measure of capacity to pay, we haven't captured that.
I just keep coming back to Flint, right?
Right. Well, those are great questions. We're kind of like, I think we made a step. A big step, I'd like to say, and thanks to Iman.
Other questions? Any closing thoughts from the discussants or presenters? I think we're done a little early then. No? Oh, okay. That's at 10:30, no?
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.